If someone offered you a chance to invest in a project but wouldn't give you any information about the venture, would you be interested? Of course not. Information reduces the uncertainty and thus the perceived level of riskiness of an investment. Since most investors are risk-averse, meaning they don't like taking chances when they don't have to, sharing information with the investors lowers the uncertainty associated with investing in a company. As a result, more investors are willing to put their money in, driving up the value of the company. The more people that are willing to invest, the lower returns the investments will have to pay to keep their investors happy. In this case, it is just supply and demand of capital, more supply, lower cost, which is the yield on the capital. If required rates of return fall as a result, more projects will be undertaken because they will show a positive net present value on the project. Undertaking more projects spurs the economy, creating jobs and bringing technological advancement to the marketplace. Accounting information provides a system of sharing information with investors, thus making the world a better place. In a sense, it gives us a common language of business. A common language of accounting has a significant impact on stock prices, economic activity, and the creation of wealth, jobs, and products, not just in the US, but globally. So, a well-regulated financial information system adds value to the capital markets. If you want to talk more about the role of accounting in society, stick around. We said that accounting is the common language of business. This is due to its formal, structured rules that tell us how to record almost every type of transaction. These rules generally belong to one of three groups of regulations. In the US, we use a system of regulations called US GAAP, GAAP, or Generally Accepted Accounting Principles. In 2005, the European Union and its members adopted a set of rules called IFRS, which stands for International Financial Reporting Standards. More than 150 of the world's nearly 200 countries have adopted IFRS. About 40 other countries, including China and Japan, each have their own unique local GAAP. So why do we need common rules at all? Well, common rules provide us with transparency and comparability. Transparency means that there's a standard that says companies are reporting all of the information required by the rules. This sets a minimum level of disclosure and gives investors some sense of security that they aren't missing any critical information. Comparability means we can take any two companies' financial statements that have been published under the same set of rules and compare them to each other. It isn't a perfect comparison, but it's pretty close. However, comparing across systems, for example, comparing an American company and a French company, remains a challenge. So, where does US GAAP come from? US GAAP is written by the Financial Accounting Standards Board, or FASB. The board is a group of professional accountants, academics, and industry representatives. They work together to maintain and modify the accounting regulations for the US. The board's authority comes from the Securities and Exchange Commission, or the SEC. The SEC is charged by Congress with maintaining disclosure requirements for publicly traded companies in the U.S. For tax filings, the IRS, or Internal Revenue Service, sets the standards. Wait, let's just go back to the very beginning. Luca Pacioli, an Italian monk, was among the first to document double-entry accounting back in the 15th century. Pacioli was born in Tuscany and lived there until he moved to Venice at the age of 18. In Venice, he was a private math tutor for a wealthy merchant family where he was first introduced to business. For the next 30 years, he served as a friar, teacher, and a writer, publishing books on math and chess, and working with merchant families across central Italy. At 51 years old, Pacioli moved to Milan to work for the Sforza family, the reigning local monarchy, where he worked and lived with Leonardo da Vinci until the French invasion of Milan in 1499. Most economic historians consider accounting as having been invented by the Jewish residents of the Middle East who used it to document their business transactions with the Romans and the Egyptians long before the 15th century. In 1494, Pacioli published a 27-page compendium on double-entry accounting, and as such, Pacioli is considered the father of double-entry accounting. Just as a side note about Pacioli, if you ever find yourself on campus here in Cambridge, In the HBS library, we actually have the original documents that Luca Pacioli put together talking about double entry accounting, which is pretty amazing to go and see. And just as a complete side note, as we're talking about the amazing things about the library system at Harvard, the Weidner Library in the Yard actually has one of the original Gutenberg Bibles, like from the 15th century. So if you want to think about some really cool stuff from history, you're interested in that kind of stuff, you can really find some amazing stuff right here on campus. So make sure you check those out if you're around. Double entry accounting refers to the fact that every transaction is recorded twice, once as a debit and once as a credit. It is precisely the double entry nature of accounting that allows us to balance our accounts and to produce reports used by managers, investors, governmental agencies, and many others to understand the financial condition of a firm. An entity's transactions are recorded as debits and credits, and then those transactions are grouped into a variety of reports, each with different purposes. We typically call these reports financial statements. You're probably already familiar with the most basic financial statements, the income statement and the balance sheet. The income statement summarizes all activity during a period of time, for example, a month or a quarter. It starts with the business's revenue and then subtracts expenses, ending with the profit or loss at the end of the report. In the U.S., the Internal Revenue Service, or IRS, requires income statements to be filed annually. Plus, the Securities and Exchange Commission, or SEC, requires companies with publicly traded securities to file quarterly financial statements, and at least one of those reports must be audited by a third party and filed annually. However, quarterly and annual filings are not the only financial statement publications. When I worked at Ford, we created weekly income statements for each location. We even used some daily reports as a control mechanism. This monitored the performance of department managers to make sure that their operations remained within normal limits. The income statement and balance sheet are constructed from the same transaction records. The balance sheet indicates the general health of the company at a specific point in time, for example, the last day of the previous quarter. The balance sheet is organized with the assets on the left and the liabilities and equity on the right. Think of the assets as the thing that you own, and the liabilities and stockholders' equity as how you paid for those things that you own, or assets. As you can see, where accounting rules come from and why they exist is complicated. This is why true experts in accounting regulation are typically licensed by their state and given the designation CPA, or Certified Public Accountant. To get this designation is hard. You have to pass numerous exams and practice in the field for years. We will go into greater detail on the specifics of these reports in the next few videos. In this overview, I wanted to give you some historic context of the origins of accounting. I also wanted to introduce the basic financial statements and the role they play in business.